Someone's sitting in the shade today because someone planted a tree a long time ago. These words from Warren Buffett perfectly capture what separates the wealthy from everyone else: their relationship with time. While most people focus on quick gains, Buffett has built a $100 billion fortune by understanding one fundamental truth: the greatest obstacle between you and wealth isn't lack of opportunity, but how you think about money, investing, and patience. I spent years studying what makes Buffett different. It's not superior intelligence or insider information. It's a completely different mental operating system when it comes to wealth creation. Today, I'm sharing the 5 mindset principles that transformed my own financial life after studying Buffett's approach for over a decade. By the end of this video, you'll understand exactly why most people never achieve financial independence and how you can break free from those limitations. When I first began investing, I lost 40% of my portfolio chasing hot stocks and market trends. I was doing what everyone else was doing, following tips, trying to time the market, and expecting quick results. Then I discovered Buffett's annual shareholder letters and realized I'd been playing an entirely different game than he was. The shift in perspective changed everything. The principles I'm sharing today aren't theoretical. They're what allowed me to rebuild my portfolio and achieve consistent 15% annual returns over the past 8 years. 5 Wealth Mindset Principles. Today, we'll explore 5 critical mindset principles that Buffett has demonstrated throughout his career. First, the compound interest mentality that shapes every decision. Second, the circle of competence framework that focuses your efforts. Third, the opportunity cost calculation that eliminates distractions. Fourth, the inner scorecard that keeps you on track when others lose their way. And finally, the abundance of time perspective that reveals opportunities others can't see. These principles work together as a system, reshaping how you perceive financial choices and opportunities. Let's start with the foundation that Buffett considers the 8th wonder of the world: compound interest. The compound interest mentality. Compound interest isn't just a mathematical concept. It's a complete mental framework for decision-making. While most people understand the math, they fail to internalize how it should reshape their daily financial choices. Buffett began investing at age 11 and became a millionaire by 30. By 60, he was worth about $3.8 billion. But incredibly, at age 92, he was worth over $100 billion. This means he made approximately 96% of his money after turning 60. That's not luck. It's the compound interest mentality in action. The compound interest mentality reframes every financial decision through the lens of its impact on your future compounding machine. Buffett famously calculated that a single $31.50 expense in his 20s would have cost him $300,000 in future wealth. Not because he's frugal, but because he viscerally understands the true cost of interrupting compounding. I apply this principle using what I call the 30-year impact rule. Before any significant purchase or investment, I calculate its 30-year opportunity cost, assuming a 10% annual return. That $35,000 car becomes a $600,000 decision. That $10,000 kitchen renovation becomes $175,000. This doesn't mean never spending money, but it ensures you're making informed trade-offs with a clear understanding of the real costs. The compound interest mentality also transforms how you view saving. Most people save what's left after spending. Buffett does the reverse. He invests first, then lives on what remains. As he says, do not save what is left after spending. Spend what is left after saving. This subtle shift places compounding at the center of your financial life rather than the periphery. When I embraced this mentality, I automated 30% of my income into investments before I saw a single dollar in my checking account. The psychological impact was profound. I stopped seeing saving as a sacrifice and started viewing it as the primary mechanism for my wealth creation. The most powerful aspect of the compound interest mentality is patience. Buffett has held some investments for over 30 years, allowing compounding to work its magic without interruption. While others jumped between investments chasing returns, Buffett demonstrated extraordinary patience with companies like Coca-Cola, American Express, and Apple. Imagine planting a tree and digging it up every few months to check the roots. That's what most investors do with their investments, never allowing compounding to achieve its potential. The compound interest mentality reframes impatience as the ultimate financial cost. The Circle of Competence Framework. The second principle is the Circle of Competence Framework, a mental model that determines where you should focus your financial and intellectual resources. Buffett credits much of his success not to what he does, but to what he systematically avoids. The size of your circle isn't important. Knowing its boundaries is, Buffett explains. While most investors try to understand everything, Buffett concentrates intensely on businesses he completely understands, ignoring everything outside his circle regardless of potential returns. During the late 1990s tech bubble, Buffett was ridiculed for avoiding internet stocks despite their soaring valuations. When asked why, he simply stated, "I don't invest in things I don't understand." While others were seduced by stories of new paradigms, Buffett stayed within his circle of competence. When the bubble burst in 2000, Berkshire Hathaway significantly outperformed the market. The Circle of Competence framework isn't about limiting opportunity, it's about concentrating your resources where you have genuine insights. Buffett reads 500+ pages daily, but he doesn't read broadly, he reads deeply within specific industries where he can develop meaningful advantages. I discovered the power of this principle when I stopped trying to understand every investment opportunity and focused exclusively on consumer businesses with strong brands. By developing deep expertise in a few industries rather than surface knowledge across many, I began making investment decisions with genuine conviction rather than uncertainty. The framework applies beyond investing. In business and careers, the most successful people aren't those who pursue every opportunity, but those who ruthlessly focus where they have natural advantages. Buffett recognized early that his analytical mind was perfectly suited for investing, not operations or management. This self-awareness allowed him to concentrate on his strengths rather than improving his weaknesses. To apply this framework, conduct an honest assessment of where you have informational or analytical advantages. What industries do you understand better than most? Where does your experience give you insights others might miss? Then focus exclusively on opportunities within that circle, systematically ignoring everything else regardless of how appealing it might seem. The circle of competence creates another advantage: confidence during market volatility. When you deeply understand your investments, market fluctuations become opportunities rather than threats. As Buffett says, risk comes from not knowing what you're doing. When operating within your circle, you'll have the confidence to act when others are paralyzed by uncertainty. The opportunity cost calculation. The third principle is the opportunity cost calculation, a mental framework that continually compares each potential use of capital against your best alternative. While most people evaluate opportunities in isolation, Buffett always asks, is this the best possible use of these resources? Buffett's longtime business partner Charlie Munger explained this concept. Intelligent people make decisions based on opportunity costs. In other words, it's your alternatives that matter. In practice, this means every dollar you deploy must compete against your best investment idea. This principle transformed how I make financial decisions. Instead of asking, is this a good investment? I now ask, is this the best investment compared to my existing opportunities? This subtle shift eliminates good but not great options, focusing your resources on truly exceptional opportunities. Buffett applies this thinking to time as well as money. He famously keeps an almost empty calendar, declining most meeting requests regardless of who's asking. He understands that every hour spent on one activity is an hour not invested in reading, thinking, or analyzing his highest priority opportunities. The opportunity cost calculation also explains why Buffett lives frugally despite his immense wealth. His famous quip about the folly of trading in 10,000 hamburgers for a private jet isn't just humorous, it reflects his constant awareness of opportunity costs. For Buffett, every dollar spent on consumption is evaluated against the potential future value if invested instead. I apply this framework using what I call the one-in, one-out rule for investments. Before adding any new position to my portfolio, I must identify my least compelling current holding. If the new opportunity isn't clearly superior to my worst current investment, I pass. This prevents portfolio dilution and ensures each dollar works as efficiently as possible. This principle becomes particularly powerful when combined with the circle of competence framework. By focusing only on opportunities within your circle and then selecting the best among those options, you create a powerful filter that eliminates distractions and maximizes returns. The opportunity cost calculation also explains Buffett's extreme patience. He can wait years or decades for the right opportunity because he's always comparing potential investments against his hurdle rate, the expected return of his existing investments. Only when new opportunities clearly exceed this threshold does he act. The inner scorecard. The fourth principle is the inner scorecard, a mental framework for making decisions based on your own values and analysis rather than external validation. Buffett distinguishes between people who live with an inner scorecard versus an outer scorecard. Those with an outer scorecard make decisions to impress others. Those with an inner scorecard act according to their own deeply held principles. This distinction explains why Buffett could ignore the new economy hype during the dot-com bubble, why he could purchase $5 billion of Goldman Sachs during the 2008 financial crisis when everyone was fleeing financials, and why he could maintain huge cash positions during bull markets despite criticism. The inner scorecard is perhaps the most difficult principle to implement because it requires swimming against powerful social currents. When friends are getting rich on speculative investments, when media headlines stoke fear or greed, when financial advisors push complex products. Maintaining independent judgment requires extraordinary mental strength. Buffett offers a thought experiment to develop this mindset. Would you rather be the world's greatest lover but have everyone think you're the world's worst? Or would you rather be the world's worst lover but have everyone think you're the greatest? The inner scorecard mentality chooses reality over perception every time. I've found 3 practices that strengthen my inner scorecard. First, I write down my investment thesis before making any purchase, clearly articulating why I believe this opportunity is exceptional. This creates accountability to my future self rather than external validation. Second, I conduct regular portfolio reviews focused on process rather than outcome. A good decision with a poor short-term outcome still scores high on my inner scorecard, while a poor process with a lucky outcome scores low. Third, I deliberately limit my consumption of financial media and discussions of my investments with others. External voices, even well-intentioned ones, can weaken your inner scorecard by introducing doubt or FOMO that wouldn't otherwise exist. The inner scorecard becomes particularly valuable during market extremes. During the March 2020 COVID crash, while others panic-sold equities, my inner scorecard indicated that high-quality businesses were suddenly available at exceptional prices. This independent judgment allowed me to deploy capital when external voices were screaming to do the opposite. As Buffett says, the stock market is designed to transfer money from the active to the patient. The inner scorecard is what makes sustained patience possible. The abundance of time perspective. The fifth principle is the abundance of time perspective, a framework that expands your investment horizon far beyond what most people consider. While the average investor thinks in terms of months or quarters, Buffett famously stated that his favorite holding period is forever. This extended time horizon completely transforms how you evaluate opportunities. When considering a potential investment over a 20-plus year horizon, short-term volatility becomes irrelevant competitive advantages compound, management quality becomes paramount, and business models with inherent durability rise to the top. Buffett isn't just theoretically long-term. He demonstrates this perspective through action. He purchased See's Candies in 1972 and still owns it today. He began buying Coca-Cola shares in 1988 and hasn't sold a single share in 35 years despite numerous opportunities to take profits. This isn't stubbornness, it's a fundamentally different relationship with time. The abundance of time perspective explains why Buffett focuses intensely on businesses with enduring competitive advantages or moats. When your time horizon extends decades, temporary advantages like technology without network effects or brands without emotional resonance become unattractive regardless of current growth rates. I implement this principle through what I call grandchild thinking. For each potential investment, I ask, would I be comfortable putting this in a trust for my grandchildren that couldn't be accessed for 50 years? This forces me to evaluate business durability, competitive position, and management stewardship over truly long time frames. This perspective also changes how you view market volatility. When your horizon is measured in decades, market drops become irrelevant or even advantageous. As Buffett famously said during the 2008 financial crisis, bad markets are good for good investors. The abundance of time perspective allows you to perceive opportunity where others see only threat. Perhaps most importantly, this principle combats the most dangerous tendency in investing: hyperactivity. Most investors dramatically underperform market indexes not because of poor selection but because of excessive trading. The abundance of time perspective encourages decisiveness followed by patience, the opposite of the constant activity that destroys most portfolios. Integrating the 5 principles. These 5 principles don't operate in isolation. They form an integrated system that fundamentally reshapes how you approach wealth creation. The compound interest mentality provides the mathematical foundation. The circle of competence framework focuses your efforts where you have advantages. The opportunity cost calculation ensures optimal resource allocation. The inner scorecard maintains independent judgment during market extremes. And the abundance of time perspective allows compounding to work its magic uninterrupted. Together, these principles create a wealth-building flywheel where each reinforces the others. The circle of competence gives you confidence in your investments, which strengthens your inner scorecard during volatility, which enables the patience required for compound interest to work, which provides the long-term perspective to ignore short-term distractions. Implementing these principles requires more than intellectual understanding. It demands a fundamental shift in how you perceive money, time, and opportunity. It means adopting mental frameworks that often contradict conventional wisdom and social pressure. Taking action. So how do you begin implementing these principles in your own financial life? I recommend 3 specific actions to start your transformation. First, conduct an honest assessment of your circle of competence. List industries and business models you truly understand based on professional experience, personal interest, or deep study. Then ruthlessly limit your investments to opportunities within this circle, regardless of what's currently popular. Second, automate your investing to harness the compound interest mentality. Set up automatic transfers that direct at least 20% of your income into investment accounts before you can spend it. This single habit will dramatically increase your wealth over time by putting compounding at the center of your financial life. Third, develop your inner scorecard by writing down your own investment principles, the criteria that matter to you based on your goals and values. Review these principles regularly, especially during market extremes when external voices are loudest. The transformation won't happen overnight. Even Buffett's approach evolved over decades of experience. But with each decision guided by these principles, you'll gradually rewire your financial thinking from short-term speculation to long-term wealth creation. Remember, the only thing that truly stands between you and wealth isn't external circumstances, but your own mental frameworks. As Buffett himself said, the most important investment you can make is in yourself. By adopting these 5 principles, you're making precisely that investment in your own financial thinking. In next week's video, I'll be breaking down specific companies that exemplify the qualities Buffett looks for in long-term investments. If you found value in today's content, please share it with someone who might benefit, and subscribe to ensure you don't miss future insights. Thank you for investing your time with me today. The principles we've discussed aren't complicated, but they're profoundly different from how most people approach money. By implementing them consistently, you can transform your financial trajectory and, more importantly, your relationship with wealth itself.